Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to go ahead and analyze gold and silver. One of the questions people asked is, uh, metals rise as fears of default rise, but when default appears moments away, the markets sell off. Well, that's more or less true because what happens is that when markets sell off, it's because either the fundamental characteristics or the demand characteristics have altered so significantly they have no choice but to sell off. Why sell off? Well, if in the event these European governments do default or they get a humongous bailout, the humongous bailout will cause some characteristic scenarios that are kind of bad for trading algorithms that are already on the market. But let's go back to the main point, which is when fears of default rise, what happens just a moment away from default? Well, of course, gold and silver will crash in valuation if, in the event, we know for a fact that the Italian government will default in a couple days' notice. If that day ever came where the Italian government just gave a notice saying a couple days in advance, we're not going to pay our bills anymore, we're not even going to do a partial default, we are just going to let you sit with a bunch of useless bonds. The moment they make that announcement is the moment gold, silver, and stocks will crash, along with crude oil and various other commodities. Okay? And the only thing that will honestly be bid up is the dollar's value, the Japanese yen value. Every other currency that just doesn't get bailed out, have to get bailed out, doesn't have to be, basically anywhere that's a store of value that's still considered a currency that has not been impacted too severely also to be in consideration for default as well. So again, the main point is that as long as the nation isn't about to default, and they can convert their currency into a form of currency that's not at immediate risk of no longer existing, those currencies will be bid up. And in the process of those currencies being bid up, gold and silver will have to devalue. Now, moments away, yeah, chances are gold and silver will sell off. Now, when if the European Central Bank decides to save the euro, and decides to throw out a $3 to $4 trillion bailout for these pigs, you're gonna shorten the stem of pain. You're gonna drop a loaf of bread on the markets, and they're gonna eat it quite thankfully, and markets will probably continue going higher from that point onwards. It just doesn't really make sense for the European Central Bank, and the main reason being is that just because they spend more money trying to bail these institutions or these governments out, it doesn't mean these governments can become financially sustainable at any point in the future. Not with dropping GDP growth, not with falling tax revenues. And if you raise the tax revenue, that will cause the tax revenues to fall even further, therefore further compounding the issue and further worsening the deficit. All the while, these regional banks are selling their bond positions. Once they sell their bond positions, that will cause even further interest rates going interest rates will continue to go even higher. Eventually banks continue to lose more money, so they cannot lend money, and when you no longer lend money and people are being fired at their jobs in the government, you're going to have a triple whammy, because first, banks are bailing out of bonds. When you bail out of bonds or sell your bond position, you convert it into currency, which is the euro. You take that euro and you export it outside the country. That's money that's no longer in Europe. Okay, so that's domestic currency that's no longer there. So that's the second double whammy. Third double whammy is, or triple whammy, is where interest rates continue to rise and these governments just can't pay back the loans. And the fourth, or the quadruple whammy, is eventually when none of this becomes sustainable, because it becomes counter-sustainable, or in fact it implodes upon itself, because these governments aren't receiving more tax revenue, or even if they are receiving more tax revenue, it really isn't that much more, because the economy is actually decelerating at a really rapid rate. Interest rates still continue to go higher. The people who lost their jobs due to governments cutting back on their labor force causes even further strain on the economy, because more people are going bankrupt. When you cause a higher number of bankruptcies, banks have even less reason to lend, plus they already lost a lot of money from bonds, and therefore what's going to happen is that eventually the European zone will go into a depressionary state. The depressionary state is happening because of various reasons, and because the fundamental characteristics of their economy weren't sustainable to begin with. And once that happens, you're going to see a lot of currency disappear. When you see currency shrink, then the total value of currency, that's going to be the end of it. Gold and silver will no longer see a rally. Now, if in the event the European Union gets a humongous bailout, let's assume that they, throw out $4 or $5 trillion to make sure the pigs are able to eat for maybe a couple more years, you're going to see gold and silver appreciate for a couple more years. The only problem is that the dollar is going to rapidly, appreciate to the euro because the total number of euros have just almost doubled, maybe, or have gone up by around 25%. And therefore, the euro-US dollar pair will have to go down by 25%. When the euro-US dollar pair goes down by 25%, since it has a 50% weighting on the dollar index would have to go up an additional 10%, or 10 to 15%. If the dollar index were to go up an additional 10 to 15% from this area, that would be an added $7 to $12. $7 to $12 would put this right back at around $88, which would basically be at its previous all-time highs. And if that happens, that puts to question the whole entire European system itself. It means that the dollar is a means of safety, because not only has the euro been inflated to record highs, these governments are running even deeper deficits by then, and when they run even deeper deficits, the likelihood of them having a default increases even further down the road after receiving a bailout from the European Central Bank, which they most likely will. And therefore, when they get a super huge collapse, where instead of defaulting on $2 trillion, Italy defaults on maybe $4 or $5 trillion. And the European Central Bank can no longer bandage the wound any further, and the European Central Bank just steps down and concedes that they cannot do anything any further. The International Monetary Fund cannot sum up additional funds. Eventually, interest rates continue to go higher, and of course, Italy just eventually goes bankrupt along with the rest of the pigs. Once that happens, it's game over. The dollar index goes even further. Goes up even further to ridiculous levels. The euro does become worthless. After all, none of the people within the country depositing their money in the banks, none of that money is even euros anyway, because what they've deposited now, what the banks have converted, what the depositors have deposited, they converted that into Japanese yen, they've converted that into US dollar, but the banks themselves are no longer holding on to the native currency that these people have deposited into these banks, and the banks themselves are probably only carrying around 5% in euro, and they've probably by then would have allocated themselves 60 to 70% into other currencies, and that will cause a lot of strain on the European economies as a whole, because when 70 to 60% of the money that was in the banks is no longer there and is exported outside of Europe, you have basically suffocated your own economies, and your economies are doomed, because again, your money, the money that these European citizens have deposited, aren't in the form of euros. They're in the form of Japanese yen, US dollar, gold, silver. Is not being invested into the domestic European economies at all. And therefore, these European economies are essentially doomed because their banks have totally abandoned their own economies. That's it. Eventually, these governments cannot pay back their money because the banks are not lending money into small businesses, into the domestic system. When you don't get that revenue base of consistent growth caused by lending, caused by the money multiplier effect, essentially the banking system has failed, and it already more or less has. If we get a bailout, you're going to see gold and silver continue to appreciate for a couple more years. If not, gold, silver, and stocks will collapse immediately, starting the moment the European economies no longer function, which will happen in a couple more years. I hope that explains everything for you guys. Again, it is a very morose tone, but it is the absolute truth. After all, we, or I, at Fully Informed Trade, am here to fully inform you of what's going to happen or what is most likely going to happen based upon what we currently know. So again, thanks a bunch, guys. If you have any questions, leave another comment below. I'll be happy to answer your question, or I make it a topic of discussion on my next video. And also, be sure to keep checking out my videos, subscribe. It helps a bunch because, again, subscription rates improve. It just benefits everyone as a whole, and it encourages me to make more content on a regular basis. Take care, folks, and I'll go ahead and see you guys in a couple more days, or within a couple weeks. See ya.